Hello, fellow Rebel Capitalists. Hope you're well. So, I wanted to go over a chart that I've been thinking about a lot over the weekend, and it really depicts the economic crisis facing the United States right now. Right now, and nobody's talking about this. And I obviously the government wants to keep this a secret. The mainstream media wants to keep this under wraps, but it's really important that we're cognizant of this so you can prepare and you can not only survive but hopefully thrive what is inevitably coming our way. And I always talk on this channel that there are no certainties, there are only probabilities. But this economic crisis that I'm going to be talking about in this video, I think it is as close to a certainty as you can get. I would peg it at probably 99%. Let me show you what I'm referring to. We go to this chart, and this is, I'm going to give credit here. This is Texas A&M University. And so they came out with this blog post. Is there a limit to government? Well, there is. There is a limit to government as far as a percentage of the economy. That would be 100%. Now, the problem is when you get to 100%, the government controlling 100% of the economy, that is communism. That is what Russia did pre, let's say, 1990. And as we all know, it didn't work very well. It didn't pan out for the average Joe and Jane. And it led to quite literally hundreds of millions of people dying as a result. So we know that if the government gets to 100% of the economy, by definition, that is communism, Marxism, socialism, whatever you want to call it. That's the bottom line, is whatever you want to, whatever name you want to attach to it, it's bad news for the average Joe and Jane, and it means the standard of living for everybody, except maybe those who are politically connected. But I would argue that their standard of living actually goes down as well. So for the 99% of the population, their standard of living plummets. So, it's and also another interesting question is what's the difference between a massive economic depression that we saw in the 1930s and hyperinflation that you saw in Weimar Germany? Like at the end of the day, what's the difference for the average Joe and Jane? My answer is there is none. There is none. Their standard of living plummets. And that's what we're talking about here. Look at this chart. I'm going to try to zoom in for you guys, because we're going to be going over a few charts today, but this is right where it starts. So I think we can all agree if the government is 100% of the economy, that is communism. And that is going to lead to massive inefficiencies. And that's going to lead to fewer goods and services, which by definition is going to make us all poorer, right? So we can all agree that 100% and you're there, right? Look at where the U.S. is right now. And I understand this chart goes to 2020, but I'm going to pull up some more charts that show you we're basically right here. 46% of the entire U.S. economy is a result of the government spending. And you all know that government spending is going to make the economy far less efficient. It distorts the economy. Going back to the example of communist Russia is perfect, right? So you can imagine an economy, let's say going back to, the late 1800s, and we're going to go back to that in a moment here. But you can imagine an economy where the government spending or the government as a percentage of overall economic output was, let's say, 5%, and the private sector was 95%. What would you expect the standard of living to be doing in that economy versus an economy that's 95% or 100? See, I think we really need to take it to an extreme as a thought experiment to understand how this works and where we are inevitably headed. And unfortunately, I think we're headed there sooner than later. But the good news is at the end of this video, I'm going to give you some options as to what you can do to not only protect yourself, but help, hopefully, I mean, I hate to say it, but better your position, increase your standard of living. Although everyone else around you, their standard of living will most likely be decreasing. So now let's go ahead and go down. So we know right now we're basically around 46%. And you can say, well, George, that was during the cerveza sickness. No, 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 no. Let's look at some more recent charts where we see that state and local is, call it 4 trillion. And the federal is 10.2. So right there, we're at 14.2. And nominal GDP is, call it 30. So we're right around the 46 mark. Unfortunately, we haven't really, we had this big spike up and we haven't dropped down like we did in, let's just say, World War II, where we had this big spike up and we dropped down. Here, we had a big spike up, but then we kind of plateaued. And if you think about the projections for spending, government spending, and then you look at the projections for GDP, you see why I'm saying it's almost inevitable that this goes higher and higher and higher. And I think it's going to go up higher at a rapid rate. So my base case is if we're at 50% right now, by 2030, I would not be surprised if we were at 75%. And I know that sounds crazy, that the government in the United States could be 75% of the economy. But let's just do the math. Let's just think about this. We go down to this chart. Projected federal spending as a percentage of GDP. Okay, so this goes out to 2051. But keep in mind, this does not include a recession. So look, even if you think the economy is booming right now because of Trump or whatever, right? I mean, that's fair. Everyone is entitled to their own opinion. But even if you think the economy is booming right now, I don't think anybody watching this video would say that there's no way we're ever going to have a recession again. I mean, nobody would say that other than Janet Yellen. I mean, no one in their right mind would say that. We will have a recession. Now, are we in recession right now? I don't know. I mean, you could make a good argument. We are, especially after the non-farm payroll. But to say that we're never going to go into another recession, and we absolutely will not go into a recession in the next 5 years, or we've somehow canceled recessions. And I know I did a video on that the other day, but even if they fudge the data moving forward, that still doesn't impact this, unless they just lie about the federal spending numbers and the state and local, which even if they do, we're going to see this show up in the real economy. Because what I was talking about in that video is more about markets, right? And more about just government admitting there's a recession. What I'm talking about here is the standard of living for the average Joe and Jane, and how on earth they can protect themselves and how dire a problem this is. I mean, this is not fear mongering here, guys. This is math. This is math. So you can, make fun of the title or the thumbnail or whatever all you want. But if you really want to have a intellectually honest debate about this or a rebuttal, debate the math. That's where we got to start. So getting back to this, I think that everyone in the right mind would assume that, yeah, we're going to have a recession. So now let's go back to see what happens during a recession or a crisis. I mean, you could call World War II that type of crisis. And what happens, you get the big spike, then it comes back down. But what does the trend do? It goes higher and higher and higher and higher and higher and higher. and then you kind of level out a little bit, and then you have, everyone kind of gets lackadaisical, let's say. The debt's no longer a problem. And again, you see, most people focus on the wrong thing. And this is why I am so adamant about people not getting caught up in the debt. And oh my gosh, the debt is unsustainable. The debt's unsustainable. The debt's unsustainable. Who cares about the debt? Like, who cares? like the debt is sustainable, right? The debt's not our problem. The debt isn't our problem, because let's assume for a moment, because what most people do is they pull up this chart and they say, look, the debt's unsustainable because it's over 100% of debt to GDP. Okay, great. Fantastic. Well, what's the solution there? Well, the solution is to get the debt to GDP down below 100%. And then it's sustainable, because then there's going to be plenty of demand for our treasuries and interest rates aren't going to go up. Okay, does that solve our problem, or does that make it worse? It makes it worse. It makes it worse, because then there's no even fake constraint on government spending. And let's just assume, as for a moment, that we could just do a debt jubilee. And we could, really. And that takes the debt to GDP down to 90%, because we do a debt jubilee. We just wipe out all the debt that's on the Fed's balance sheet, the U.S. federal debt, right? So let's just assume for a moment that gets the debt all the way down to 90%. So then what most people would say is, oh, well, that's just, all our problems are solved, because now the debt's sustainable. Well, are all our problems solved? Because if we go down to 90%, guess what's going to happen to this number? It's really going to moon. It's going to skyrocket. It's going to go parabolic, because now there's not even a fake constraint. There's not even a narrative that there should be a constraint on government spending. And this, as a percentage of GDP, is going to go higher and higher and higher and higher and higher. And this is the problem, because like we said at the beginning of the video, you get to 100% and we're at communism. So every percentage that point of increase is 1 percentage point closer we get to communism. That's not hyperbole. That's math. Those are the facts. So then again, we go down here and look at their projections that by, what was it, 2051, we're going to be at 32%, basically. Okay, let's assume that's true. And we're going to get to the recessions that I was talking about earlier in a moment. But assuming that's true, that takes us to, let's see, so we're at 32. So right now, federal is, you see they have it dipping down. Yeah, right. They have it dipping. They have it dipping down. Maybe it did, but state and local definitely made up for it. But they have it dipping down to 20%. So an increase of, let's say, 12%. So an increase of 12% from 20. So if we go up to 31, okay, that's what I'm doing. So we would be here with the maroon shaded area. That would be federal. This is according to their projections. But then on top of that, we have to add the 20 to 46, the 26%, or call it 30, just to make the math easy. So if we're at 31.8, call it 32, and you can, and assuming that state and local doesn't grow, which it will, right? So if the federal is going to grow at this rate, why wouldn't state and local? But assuming that state and local doesn't grow, we're at 62%. 62%. And then assuming state and local grows, we're damn near 75. And that's with no recession. So we go back to this chart and we think, okay, what are the probabilities we have a recession, a crisis, World War III? I mean, I hate to even throw that in there. But even if you take that off the table, what are the chances we have some sort of crisis where we do a GFC and we take the government spending from, let's say, 35. I mean, just look at since the GFC, we've gone from 35 up to 50. Basically 15% increase in the last, call it 15 years. And look at how much of an increase we've just had since the cerveza sickness, right? So the next, and why am I so confident the next recession is going to blow up the debt to GDP, excuse me, the government spending to GDP even more? Because you guys that are over the age of 40, you know how this game is played. You've seen it. Back in the day, we didn't have this. I mean, we did during World War II, but during like the 1990s, as an example, when we had a recession, you didn't have the government come in and spend trillions and trillions and trillions of dollars just trying to prop up the economy just so no one would feel an ounce of pain or no one would go bust. And then in .com, we took even more action. GFC, we took even more action. I'm talking about at a federal level. And then during the cerveza sickness, we just go full retard. So how on earth could you argue that if we have another economic contraction or crisis or whatever, that they're not going to do the exact same thing times 10 that they did during the cerveza sickness? Of course they are. And what is that going to do? Well, just based on their projections, by 2051, we're going to be probably 75%. Okay, so you add in a recession, and that's going to get us to 75% a hell of a lot faster. That's why I say by 2030, why not? I mean, you could be at 70, 75. And for those of you watching this video right now, if government spending is 75% of the economy, what do you call that? I know one thing it's not, and that's free market capitalism. So if it's 75% of the, I mean, do you call that socialism? Are we at, I guess we're not at communism yet. I mean, what do you call it economy? Just economic fascism? I don't know. We're going to have to come up with a new word. But I can assure you that the standard of living for the average Joe and Jane will be way lower when we're at 75 than at 50. And the increase in productivity will decline. Just everything will get worse. I wouldn't even, I honestly, I mean, I hate to even say it, but I wouldn't doubt if the average life expectancy would go down as well, because you're running into shortages of almost everything at that point. I mean, let's not forget that that Russia, in their communist days, of central planning, which is basically exactly where we're headed, they had some of the most fertile farmland on the planet Earth. And they still faced mass starvation, hundreds of millions of people dying. I'm not saying that's going to happen in the United States, but a very simple way to look at this is right now, the United States economy is 50% DMV. So you guys know what it's like to go to the DMV. Not a fun experience. That's probably not the organization that you would tag as extremely efficient. So if right now the DMV basically represents 50% of the economy, how efficiently are we going to produce goods and services if it's 75%? Right? So what you're doing is you're having the government basically squeeze out the private sector in terms of the economy. All right, my computer's almost dead. Let me plug in my computer and we're going to go over a few more charts. Okay, sorry about that. So let's get back to it here. This is another, let's do this. And here's where I'm going to get into what might be, believe it or not, an even bigger problem, or it's a problem that most people don't think about when they think about an expansion of government and central planning. So I think based on these very simple charts and just math, and the fact that we will have a recession, and the fact that the government will most likely get even more, let's say, aggressive in their approach, and we will see something very similar, if not more extreme, than what we saw during the cerveza sickness, which will take us, very close to 70, 75%. Assuming that happens, we all get it. We all get that makes it less efficient, takes us closer to socialism, communism, whatever you want to call it. But I think what most people wouldn't really observe or wouldn't be cognizant of is what that does, what that likely does to prices. Now, you notice, I'm not going to be talking about the Fed's balance sheet here. I'm not going to be talking about the Fed money printing, because at the end of the day, the Fed is not at the center of the monetary system. It's the banks. So what I'm going to be talking about is the banks creating more money, or just creating as much money as they have in the past as far as a percentage increase. All right. Assuming that the government doesn't step in with the CBDC, which they most likely will. But assuming they don't, let's look at this problem through the lens of consumer prices. And I don't want to look at it through the lens as far as consumer prices with the Fed printing money, because I don't want to go way off topic. But prior to QE, their balance sheet really didn't even change. So it wasn't the Fed that caused all the inflation. You say, well, then what did cause it? I'm going to get into that in a moment. So right here, we've got a 20-year time frame, roughly. Just we've got December 1999 to March 2020. Okay. Now, during this time, we see the black line, and this is a cumulative number. So during this time, M2 money supply, the stock of money, went up by 228%. 228%. Now you say, "Oh my gosh, George, that's insane. That's why we've had all this inflation. It was the Fed printing money." No, it wasn't. This was not a result. I mean, you could maybe argue, QE, but then you have to get into a lot of the technicalities. But prior to the GFC, again, look at the line. It's going up pretty much at the exact same pace. And that's without the Fed. That's banks. So the point here, I don't want to get into the plumbing, but the point is it's highly, highly likely that this trend continues. So if we fast forward for the next 20 years, that we should expect to see the money supply grow at the same rate. And if we get a CBDC, trust me, it'll grow a lot faster. So now let's look at this red line, because this red line is consumer prices that the government would admit to. So cumulatively, for the last 20 years, they say prices have gone up by 53%. So money supply went up by 228%. Got it. And again, we're just going to focus on math here. And the prices of goods and services went up by 53. Now, I know that's debatable, but let's not get hung up on that for this video. Now, what I want to do is go back to a different time. I want to go back to 1880 to 1900. Same 20 year. You can see I'm moving this down at the bottom so we keep the exact same time frame as far as the 20 years. And let's look at the black line first, the growth of the money supply. And you'll see right here, 250%. Now, as a reminder, from 2000 to 2020, it was 228%. So, yes, and I know this shocks most people because they think a gold standard actually constrains money supply growth. When if you actually look at the data, you see that's total fake news. Like, hello, right here, right here. We got money supply growth, 250%. Yay, gold standard. Okay. But that's not the point of this video. The point is we had a greater increase in the overall money supply. But look at prices. Prices went down by 20%. 20%. So think about that from a standpoint of the average Joe and Jane. If you're making, let's say in 1880, you're working a job at McDonald's or something like that, and you're making $1,000 a month, and you don't have any money left over. No money left over because your paycheck is $1,000 and your expenses are $1,000. And let's say you work that same job, flipping burgers, for the next 20 years, and you don't get a pay raise, and you don't get a promotion. But at the end of 20 years, you have $200 left over every month. Whereas at the beginning, you're flat. You didn't have any money left over. Why? Because the cost, your expenses went down by 20%. So what did that do to your standard of living? It increased it. What did that do to your purchasing power? It increased it. So then the question becomes, how on earth can the money supply grow 250%? How can the money supply grow faster than it did between 2000 and 2020 when we had QE 1, 2, 3? We had crazy profligate governments. We had all this insanity. How is it possible that the money supply grew at this rate while at the same time the cost of stuff, the expenses went down by 20%? And the answer, of course, is because the economy was so efficient that it was producing more goods and services than the expansion of the money supply. In other words, if the money supply grew, and these are just, I'm oversimplifying here, but if the money supply grew by 250%, the amount of stuff in the economy grew by 300% in those 20 years. And that's how the price of stuff goes down, which accrues the biggest benefit to the poor and middle class. Everybody's standard of living increases. Everybody's purchasing power goes up. Think about it in these terms as well. You could just put money in the bank back then. Just put money in the bank. And I've looked at interest rates back then, by the way. And interest rates were 3%, 4% that you could get on your checking account. So think about that. You're getting 4% on your checking account, but the price of stuff is going down by, and I know the math isn't exact here, by 1% per year. So you're getting a real return on cash, for heaven's sakes. Cash in your checking account. You're getting a real return of like 5% per year. I mean, nowadays, let's go back to where we are today. And obviously, it's even worse since the cerveza sickness. But where we were today, where we started here, is we've got prices going up by 50%. So if prices are going up by 50% during this time frame, what would have happened if you would have just had cash? Or you would have had it in a bank where they're paying you 5 basis points, even though Fed funds is at 5%. Well, you guys know the answer to this. You would have gotten crushed. So then you go into bonds. Okay, great. Well, there's times when you might make a real return, but that's if you believe the CPI. If you are a realist and you know that this understates inflation, most of the times you got a negative real rate of return on bonds. So your purchasing power is going down there. So what's your only choice? So your only choice is to speculate. Your only choice is to gamble on fart coin. Your only choice is to go out there and take massive amounts of risk. You say, well, George, Bitcoin isn't risk. Gold isn't risk. Yeah, it is. Yeah, it is. It is. I mean, over the long run, you can sit there and say, oh, it's very low probability that it doesn't go up with inflation. Okay, great. That's fine. But during decade-long periods with gold, it actually went down. You lost purchasing power. So this forces people to go out the risk curve. And no matter how safe you think Bitcoin is or gold, it's not as safe as having cash just in your back pocket or cash at a bank just making 5%. I'm talking about in real terms, right? That's the safest of the safe of the safe, right? So you see what this does is this basically you're forced into a position where you have to make at least 10% per year or 8%, 10%, whatever you think the inflation rate is, just to break even, just so your excess productivity, which at the end of the day is what savings is, just so it doesn't lose purchasing power and you don't just get poorer and poorer and poorer and poorer the more money you save, right? You have to go to the casino. And then we just have to hope that buying the dip works for the rest of eternity. But let's look at that. And let's look at the math there, because everyone thinks that, oh, George, this is not a problem at all, because all you have to do is put your money in the stock market and it'll keep up with the rate of inflation, or you'll grow your wealth, you'll increase your purchasing power. So although these dynamics are at play, it doesn't even matter, because you're just going to have your 401k and you're going to be in the S&P 500, and big daddy government is going to make sure the S&P 500 never goes down, and therefore it's like your retirement plan, right? And actually, I'm skipping ahead here. Let's get into this in a moment, but before we do, I want to go back to the punchline here, because what is the difference, guys, between the 2000 to 2020 and 1880 to 1900? What's the difference? Why is it that we saw a bigger increase in the money supply during the 1800s, but yet prices went down by 20%? And during this time frame from 2000 to 2020, prices went up by 50%. The answer is this, in my opinion. And it makes sense, because back in the 1800s, the private sector, meaning the non-DMV, the efficient, the portion of the economy, the entities, the humans, the average Joes and Janes that are out there producing stuff, producing goods and services, that's 95% of the economy. So is it any surprise that if money supply went up by 250, that the amount of stuff went up by 300%? No, that's no surprise at all, because the private sector was 95% of economic output. Now, is it any surprise today that at 50% that we're not as productive? We're not producing as much stuff as we were in the late 1800s. Therefore, if you have the exact same increase in money supply growth, you're nowhere near as efficient. Of course, prices are going to go up. Of course. And this is without the Fed. This is without their balance sheet. This is without even looking at the debt, because at the end of the day, the government spending isn't necessarily the debt, right? This is why we have to focus on government spending, you see? And said another way, if we look at history, then we can come to a pretty safe conclusion that the more this number goes up, like we were talking about going to 75% before, the more this number goes up, it's going to increase the need to go further and further and further and further out the risk curve. In other words, the more this number goes up, the closer we get to communism, the higher the overall inflation rate is going to be, because we're going to have less stuff. Even if we don't have more money, it's still less stuff. So you have this kind of ongoing supply shock, effectively, right? which is going to put you in the exact same position where you're going to, if you don't take more and more risk, if you don't go out there and buy fart coin, if you don't go out there and try to buy, Trump coin or some, what's, Josh, did you hear about this thing with the WNBA, the WNBA?
I have no clue. Sorry, I don't follow it.
You know what the WNBA is, right?
The women's basketball.
Women's basketball. Well, they had this kind of, they had to stop a couple games like last week because some people were throwing a green, you guys know what I'm talking about, a green adult toy. We'll try to keep it kid friendly here. People were throwing green adult toys out onto the court, and then they would have to stop the game, and then this of course would make ESPN and it would make the news and everyone would be talking about it on social media, right? Do you know why they were doing that?
No clue.
Because they came out with a crypto coin, the green adult toy crypto coin.
The WNBA did?
No. The pump and dumpers. The pump and dumpers created a green adult toy coin, and to pump it, they threw green adult toys on the NBA court because they knew it would make the news and everyone would be talking about it. And then all the people go over there and say, oh, there's a green adult toy coin. Buy. That's where we are in the United States today. That's where we are. Why? It makes perfect sense when you look at this chart. And when you compare that to this, because people, now I'm not making any excuses for this because unethically, I think this is disgusting what they're doing with these pump and dumps. But I get it because people are put into a choice where this is the only way they can keep up with inflation. This is the only way they can even maintain their purchasing power. And unfortunately, guys, it's going to get worse. It's going to get worse. Now, I can't even remember. Josh, what was I talking about? I skipped back and I'm going all over the place here.
I think that people need to go further and further up the risk curve to get a return.
Yeah, I know that, but I was going over something else. It doesn't even matter because this is really what you guys need to know. It's if you believe this going higher is inevitable, you also must believe that it's going to be harder and harder and harder to maintain your purchasing power, and people are going to be required to do something. You cannot put your money in the bank. You cannot put your money in the stock market. Oh, that's what I was going to say. I reminded myself here. So now the argument that we were talking about, the pushback that you'll get is, oh, just put your, Dave Ramsey. Oh, just put your money into a 401k. Because we know that over time, stocks always go up. They always go up. They always go up. This is total nonsense. This is the most intellectually dishonest or lazy argument I have ever heard in my life. Let me show you what I'm talking about. This is a chart of the S&P 500. And what I want to do is let's just go all the way back here. So we're going back to, call it 1928. Now you'll notice, you're like, oh, George, but look at this. It just goes up all the time. Well, it's true. Just buy the dip and it always goes up. Right. In nominal terms. But what we're talking about here is maintaining your purchasing power, or hopefully even growing your purchasing power so you're increasing your standard of living. So what we have to do is we have to adjust for the rate of inflation. Now, what we're going to do is we're going to adjust for the government's rate of inflation, which we all know is understated. Tells a little bit different story here, doesn't it? So if you were to buy stocks in 1928, let's say 1930, just to make the math easy, right? And let's say it's 452 or whatever. That's what the S&P 500 was when you adjust for inflation. And you held that for 50 years, 50, 50, you would have lost money. The S&P 500 adjusted for inflation in 1928 was 452. We fast forward to the recessions of the 1980s, early 80s, and you can see right here, 374. And that's if you would have held for 50 years. So this idea that all you have to do is put money in the S&P 500 in an index in your 401k, and you're somehow going to just beat inflation, and this is going to be your retirement fund because you're going to be so rich and you're going to increase your standard of living to where you don't have to work. That's complete nonsense. All what that does is that simply looks at 1980 to 2000, and then it ignores 2000 to 2010, and then it looks at 2010 to 2020. And then, so it takes 20 years, or excuse me, it takes 30 years out of the last, let's call it 100. So out of the last 100 years, it takes 30 years, and that's what it builds a narrative around. That because something happened 30% of the time, we should just assume that it's going to happen indefinitely into the future, forever. I mean, would anybody in their right mind make that argument? No. It's stupid. It's like I said, it's intellectually lazy. Well, at the very least, it's intellectually lazy, and probably worse, it's just intellectually dishonest, because it's not like this chart that I'm looking at is some sort of proprietary information. This is right there on the internet. Anybody can access this stuff, right? And so then you say, oh, well, you switch back between this and bonds. No, you look at that 60-40 portfolio, and sometimes it works, sometimes it doesn't. I mean, we look at the 10-year. Now, I'm looking at this. Now, again, if we go into a recession, are you probably going to make a capital gain at the long end of the curve? Probably. And, do I think interest rates will probably lower in a year? Sure. But that doesn't mean over the next, between now and 2030, I think interest rates are going to be lower, because they do. They go in cycles like this. You guys know this. So even if the 10-year goes back down to 2, which I think it probably will, or it could, that doesn't break the trend. So say we're on this trend now, where interest rates are just going higher and higher and higher, even though we do have long periods of time where they go down. But interest rates go higher and higher and higher. Okay, fantastic. Well, what was the stock market doing back then? So let's look at that. The stock market we just did, but but you guys know the punchline here. We look at the stock market. Okay, so let's go to what was that? 1960 or so. So if you would have been in stocks in 1963, yeah, I mean, if you would have got lucky and sold at the right time, you would have made money. But if you would have just held, through that bear market in bonds, you would have gotten crushed. You would have gotten smoked. You've got destroyed on your bond position, and you would have gotten destroyed on your stocks. So this 60-40 nonsense that, this all-weather portfolio that you just 60% stocks and 40% bonds, and if the stocks go up, you have this this equilibrium and this hedge. It's excuse my French here, but it's straight bullshit. It's straight bullshit. What they do is they just cherry pick certain times in recent history and extrapolate that indefinitely into the future. So now that we understand the problem here, and I think we can all agree that it's inevitable. I mean, when you look at that chart of government spending as a percent of GDP, I don't know anyone that thinks by 2030 that's going down. Or I don't know anyone that thinks that if we don't have a recession, that's not going straight to 65 or 70%. And then when you include the ramp in government spending as projected by the government, then that takes us to 75% real fast. And if we can safely conclude that as a result, we're going to see higher rates of prices with the same amount of money growth, and that's going to push people further and further out the risk curve, that means that there's a lower probability that you maintain your purchasing power with your savings or your excess productivity. So what do you do? What do you do? I think you've only got one choice. You have to look at portfolio construction, and you have to understand how to, over the long run, put the odds on your side of making over, let's say, 10% in order to increase the purchasing power of your savings, right? And so this, what I did is I put a link in the description for the Rebel Capitals Pro that I have with Lynn, Chris, Brent Johnson, Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Seresna, Jason Hartman. If you want to check it out, you can. I think Josh just put it there. But what we do, well, that's the school link, Josh, not that one. The one, just forget the school link. Just go over to the one that I put in the description of the video. So what we do over there, here's the bottom line, is we look at not only things that are cheap. You know, I talk about that all the time. You buy things when they're cheap, you sell them when they're expensive. But you also have to have a catalyst. I mean, Jim Rogers teaches us this. And then you look at what I call a portfolio matrix. There's really only 3 levers you can pull in your portfolio. Number 1 is your win rate. So what we're doing in Rebel Capitalist Pro is we're trying to go over picks from Lynn's portfolio and Chris's portfolio as an example to help our members increase their win rate. That's number 1. But you're only going to increase your win rate so far, right? You're never going to have 100%. I mean, let's remember Stan Druckenmiller's win rate's 55. So then the other lever you can pull on the opposite end is the number of bets you make per year. Well, because then what happens, you have the law of large numbers on your side, like a casino. But the odds of the average retail investor, you know, making more than 10 trades or 10 investments per year, that's very unlikely. It's very unlikely because you've got other things to do. You got to live your life. So really the main lever that you have to focus on, whether it's in Rebel Capital's Pro or not, is asymmetry. You have to get good at cutting losers and riding winners. You have to get good at that. Because if you don't, I can tell you what your future is. And your future is your standard of living is going to decrease. That's your future. Because the only way that you're going to be able to beat the S&P or you're going to be able to make more than what the cost of goods and services are going up over the long run is if you get really good at that one lever that you have the most control over. And that's asymmetry. That's the bottom line. And this is what we really harp on in Rebel Capital's Pro. And that's why mentorship, you have to get some mentorship if you don't understand how to do this, whether it's with Lynn Alden, Chris McIntosh, whether it's within Rebel Capital's Pro or not, you got to do this. Or else, like we said, it's a foregone conclusion. You're not going to be able to just save money, just produce more than you consume and expect to retire if you're even 30 or 40 years old right now. It's very, very unlikely. And you can't just park it in the S&P. You can't just do the 60-40 thing. That's not going to work either. And if you just go all in with gold, all in with Bitcoin, that might work. But now you have no diversification whatsoever. And maybe it works out, maybe it doesn't. But the only way that you can really get the odds on your side is if you do what we teach people to do and what we help people do in Rebel Capital's Pro, and that's higher win rate, asymmetric bets, and you're still making, let's just say 10 to 15 trades or investments per year. So if you want to check it out, you can. But the bottom line and what this video is all about is you guys have to be cognizant of this. You have to be cognizant of, and no one really talks about it. We talk about the economic crisis like a financial crisis or something like that, or the stock market going down by 30 or 40%, or housing. We didn't even talk about housing. That's in a massive bubble as well, just like the S&P 500. So it's not like you can park your money in that and expect to increase your purchasing power over time. So you have to be aware of the fact that this is the direction we're going. We're headed towards socialism. We are headed towards 75% government spending as a percentage of the economy. We just are. Now, whether it comes in 5 years, I think it probably will, or sooner or later, I don't know, but that's the path we're on. So you've got to be aware of this stuff, and you've got to prepare for it now. And the people that prepare for it will have opportunities, and the people that don't, unfortunately, will see their standard of living decrease, just like we saw in other crisis periods throughout history. And it might not be a result of a massive deflationary bust like we saw in the Great Depression or hyperinflation due to Weimar Germany. It will be just the constrictive nature of government spending just pushing out the private sector and making it's like death by 1,000 cuts. And we're going to wake up one day and we're going to look back at communist Russia, and we're going to, as Americans, and we're going to say, damn, why are we having all those exact same problems? And the reason is because that chart that we went over at the beginning of the video. All right, guys, check out that link in the description if you want. We do the live streams over there. We talk about this stuff. And but whatever you do, just make sure you're aware of this stuff. And make sure you're standing up for freedom, liberty, free market capitalism. And we'll see you on the next video.